Welcome back to the Deep Dive. Today we are taking a massive global business model and shrinking it down, way down, to the size of, say, a single chairlift ride.
Ah, right. We're heading into Central Europe.
We are. We're going to analyze Tatry Mountain Resorts, or TMR, the largest leisure and tourism operator in that whole region.
And the scale, the ambition there is just incredible.
It really is. We're looking at this huge empire. Stretches across 4 countries, right? Slovakia, Poland, Czech Republic, Austria, too.
Yep. And it's not just managing the slopes. They're running these high-altitude hotels, massive water parks, even golf courses.
Exactly. So our mission today, what we're digging into, is their operational and financial review, the latest one, for the 2023-24 fiscal year.
Yeah, we need to figure out how TMR actually manages all that. Geographically spread out and highly seasonal portfolio. It's tricky.
And where are they putting their money? They talk about hundreds of millions in investments. Where's that going?
And maybe most importantly, what does the financial health report really tell us about their resilience, long term?
I think, for me, the first question looking at any mountain resort company is always, what happens if it doesn't snow? How does an operation this big stabilize itself against, well, the weather?
Yeah. And that's right there on page 1, isn't it? The core strategy, diversification.
Ah, okay.
Yeah, TMR's competitive advantage is built on the fact they don't just rely on ski tickets, not at all. They operate across 7 key segments.
7, okay.
So yeah, mountain resorts, that's your cableways, ski passes, they're the biggest chunk, 38.0% of total revenue. But look closely, hotels are right behind.
How close?
30.2%, very close second.
Oh, wait a second. So their hotels,
yeah,
which, run year-round, much less seasonal, they're pulling in almost as much cash as the slopes and the passes themselves.
pretty much.
Now, that's their real anti-snow risk measure, isn't it? It's like an integrated ecosystem, not just a string of resorts.
Precisely. If you have a weak winter, maybe not enough snow, those hotel bookings, the spa packages, the restaurants, they provide a really robust buffer. They're basically selling an experience package. It minimizes reliance on any single thing, which is just critical when you're managing resorts spread across different climates, different altitudes.
Okay, let's look at the big picture numbers then. Because, on the surface, TMR is definitely attracting visitors. You can't deny the top-line success. Group revenues hit, what, EUR 206.852 million for the year?
Yeah, up significantly from the year before.
Which signals clear market demand.
Right.
And probably an effective sales strategy.
That revenue growth is definitely the good news story. It shows more people are coming, and crucially, they seem to be spending more per visit.
Okay.
But here's where the financial puzzle gets, well, really interesting, and maybe a bit counterintuitive.
Oh.
Despite that big jump in revenue, their operating profit EBITDA actually went down. Slightly, but still down. By 2.9%, landing at EUR 57.662 million.
Hold on. Okay, just for anyone maybe less familiar with EBITDA, that's basically how well the business is running day to day, right? Profit before you take out big stuff like debt, interest, taxes, depreciation on those expensive cable cars.
Exactly. It's a core measure of operating efficiency.
So revenues go up, EBITDA should go up too, unless costs just went nuts.
You absolutely hit the nail on the head. The operating profitability got squeezed hard by costs.
What kind of costs?
The source material is pretty clear here. Operating expenses jumped substantially, driven mainly by surging personnel costs.
Labor costs, okay.
Yeah, plus increasing minimum wages across all their markets.
Yeah.
Slovakia, Czechia, Poland, and then higher energy prices hitting the cost of goods and services, too. It all adds up.
How much did costs increase overall?
Personnel and operating costs together up 13.8% year over year. That's a big jump.
Wow. Okay, but TMR has been pushing dynamic pricing, right? Adjusting prices based on demand. Shouldn't that let them pass those higher costs straight to the customer? Why did the margins still shrink?
Well, it shows you just how fast and hard the labor market pressure was, especially in Central Europe. Even dynamic pricing, which is designed to maximize what you get per customer, couldn't fully absorb that level of cost inflation.
So the EBITDA margin fell.
From 31.5% down to 27.9%, that's a noticeable squeeze.
And then, when you factor everything else back in debt payments, depreciation, all that.
Yeah, you roll all those costs, debt payments, and depreciation into the final tally. The company reported a consolidated net loss of EUR 1.421 million.
A net loss.
Yep. So that's the challenge, right? Turning all that huge revenue, all that asset value into consistent net profit.
Okay, that net loss figure would normally set off some alarm bells for investors. But we absolutely have to pivot immediately. Because the most staggering number in this whole report, it's the debt reduction.
This is truly the monumental victory of the fiscal year, and it fundamentally changes their long-term picture, their viability.
How big a change are we talking?
Look at their capital structure improvement. The debt-to-equity ratio. It just fell off a cliff. Plummeted from, get this, a crisis level 1,188.7% the previous year.
Wait, nearly 1,200%.
Yeah.
That means they were relying almost 12 times more on borrowed money than on their own shareholder equity.
Right.
It's incredibly fragile, especially when interest rates are going up.
Absolutely. A very risky position. But they brought it down to 186.2%.
From 1,200% to 186% in 1 year. How on earth did they pull that off?
It wasn't luck. It was a very targeted strategic action. They went for aggressive refinancing and critically early redemption of major bonds they'd issued before.
Which ones?
Specifically, the report mentions TMR3, TMRV, and TMR2's bonds, all either fully repaid or redeemed in late 2024.
So they basically bought back their own debt early.
Exactly. And that action, it didn't just make the balance sheet look better on paper, it bought them years of financial breathing room. It strengthened their core capital structure, and it significantly lowered their risk exposure to future interest rate hikes. They basically cleaned house.
It really sounds like they decided, okay, future resilience is more important right now than showing an immediate net profit. Like debt reduction was the ultimate long-term investment for them this year.
And that leads us perfectly into their ongoing CapEx commitments, because this is not a company that's, hoarding cash. They spend it strategically.
They have to, right, to keep up.
Definitely. TMR has invested over EUR 485 million in its resorts and hotels over the last 18 years. That's a huge number. And it's all aimed at reaching that sort of premier level of service and infrastructure you expect in the top alpine resorts.
Constant investment. So what did this year's CapEx EUR 19.010 million, what did that specifically go towards?
That spending was mainly focused on key growth areas. The biggest piece went into continuing the Jasna Central Resort Hotel project. That's a big integrated complex designed to maximize year-round occupancy. Makes sense.
Right, tie into that hotel revenue stream we talked about.
Exactly. They also made some strategic real estate plays, bought the Hotel Sasanka, secured some critical land plots in the High Tatras. So this EUR 19 million, it isn't just random spending. It's really the required cost of maintaining that premier alpine dream. If they stop investing, they lose their competitive edge fast.
But the investment strategy isn't just concrete and buildings, is it? It feels like the biggest operational investment is digital, all focused on their loyalty program.
Oh, absolutely. This is probably the critical engine for maximizing revenue now, the GeoPass program.
How many members did you say?
It currently boasts 3.651 million members. It's basically the digital backbone for everything. Sales, lift passes, loyalty benefits, the works.
They just made a big change there.
Yeah, their latest move, launching November 1st, 2024, is the shift to the GoPass cashback loyalty program. They're replacing the old loyalty point system with something called GoX cashback.
Okay, cashback instead of points. Why is that a big deal? It sounds like maybe just rebranding.
No, it's much smarter than that, I think. What's the strategic brilliance here? Think about proprietary points. They often expire. They can be confusing. They restrict where you spend them.
Right, you can only use them on certain things.
Exactly. But cash back, or GoX as they call it, it's universally understood. Everyone gets cash back. It instantly lowers the perceived barrier for customers to spend money across the entire TMR ecosystem. Hotels, restaurants, water parks, ski rentals, you name it.
So it makes it easier and more transparent to get benefits.
Totally transparent. And it incentivizes the customer to spend across multiple segments, which drives up that crucial number, average revenue per visitor, makes the whole system stickier.
And the data shows it's actually working.
Yeah, the report points to it. They rely heavily on dynamic pricing for ski passes and hotel stays, right? Responding to demand, seasonality. Well, this combo led to an overall increase in average prices. It improved hotel occupancy. And maybe most telling, the average revenue per visitor in the mountain resorts specifically increased by almost 10% to EUR 26.01.
10% increase per person. So they are successfully squeezing more value out of every single person who walks through the gate, digitally and physically.
Absolutely. And the physical investments back this up too. They're pushing for that premium dynamic service. So in Jasna, they enhanced their snowmaking capabilities, always critical, reopened the Brilska ski lift.
And they hosted that big ski race, right?
Yeah, the FIS Women's Alpine Skiing World Cup, huge event. That's invaluable branding for Jasna as a top-tier resort.
You can really see that balance, can't you? Necessary infrastructure like snowmaking, but also these aspirational attractions, like up in the high Tatras.
Hmm.
They spent nearly €500,000 on a new snow groomer.
A brand new Prenuth Lightwolf, yeah. Gotta have pristine slopes for the premium experience.
But then for the summer crowd,
They focused on the experience, the wow factor. They opened that striking new viewing tower at Hertzke Plesso, 53 meters high, with a pretty dramatic 15-degree incline.
that's not just infrastructure. That's an Instagram moment, isn't it? Designed to pull in those higher-spending summer tourists who might otherwise skip the mountains once the snow melts.
Exactly. Gotta keep those hotels full year-round.
And their expansion isn't just in Slovakia. What about the Czech Republic? At Pindlarův Muklen.
Right, their key Czech resort. They added 2 new slopes there, Lesna and Priadna. It's part of a much bigger investment plan, about 300 million Czech koruna, aimed at eventually connecting the Medvedín and Svatý Petr resort areas.
Ah, so building more density and better connections within their established markets. Makes sense.
Okay, coming back to risk for a moment. We established that seasonality is probably the chief external threat, right? It's a huge operation, but the busiest months are really concentrated, January through March for skiing.
And then July and August for the summer peaks. Big gaps in between.
Big gaps. So beyond the hotel segment, which we already talked about providing that base,
Yeah.
how else does TMR smooth out those operational troughs between seasons?
What other tools do they have?
They rely heavily on 2 major ones. First, the strategic inclusion of those all-year water parks, like Tatralandia. These often have thermal pools, big indoor tropical paradise-type complexes.
Yeah, weatherproof attraction.
Exactly. Massive drivers of traffic in the off-season, or even just on bad weather days. Second, their geographical strategy comes into play again. Remember, they acquired the Multaler Gletscher in Austria.
The glacier resort.
Right. Because it is a glacier, it naturally extends the operational ski season much longer, into periods when their lower altitude resorts in Slovakia and Czechia might be closed or struggling for snow.
That geographical spread really seems fundamental to their identity. Being the CEE leader, Jasna is the flagship, biggest in Slovakia, 50 kilometers of trails.
Yeah.
But having operations across Slovakia, Poland, Czechia, Austria, that reinforces their dominant regional position.
It does, and this multi-country approach also allows for, well, selective strategic trimming. They're not just chasing growth everywhere at any cost.
What do you mean by trimming?
We see evidence they're willing to divest assets, sell things off, that don't quite fit the long-term high-return strategy.
Like what?
The Malnitz Mountain Resort in Austria, it's smaller, about 12.8 kilometers of trails. As of the end of the fiscal year, it was reclassified on their books as an asset held for sale.
Hold on, though. They're selling off a resort. Doesn't that kind of contradict the narrative that TMR is this constantly expanding empire? Does it mean an acquisition didn't work out, or maybe it's a sign of financial weakness?
I don't think it's either, actually. I see it more as a sign of mature portfolio management.
Okay, how so?
Well, divesting a smaller asset like Malnitz, which might require disproportionately high investment to bring it up to standard, or maybe struggles to integrate smoothly with the whole Geopass digital ecosystem, it allows them to consolidate their capital. Focus resources on the core growth drivers, like Jasna, like the water park expansions.
So trimming the fat to focus on the highest performers. Not weakness, but strategy.
Precisely. Mature management.
Okay, finally, let's circle back to the human capital angle, because they stated pretty clearly that personnel costs were the biggest headache for profitability this year. And they need a huge skilled workforce to run this whole machine.
Immense workforce needed. They actually grew their total employee base to 1,527 people, which shows the demand for staff is there. But the local labor shortage, particularly in Central Europe, is real. The pool is tapped out.
So how do they cope?
To address this, TMR relied really heavily on temporary staff. They hired 702 employees just through agencies. But maybe more critically for the long term, they've launched new initiatives to hire internationally.
Internationally? From where?
Specifically, the report mentions cooperating with nationals from what it calls third world countries.
Yeah.
The Philippines and Thailand are named using a national visa program.
Wow. So when you run an operation this massive, the most critical resource isn't necessarily snow or even money. It's people.
Yeah.
Finding enough skilled staff. And the fact that TMR is actively, aggressively recruiting in places like the Philippines and Thailand, it just shows they're fighting a global battle for talent simply to staff their resorts adequately.
It adds complexity, it adds cost, definitely. But it seems like a non-negotiable step if they want to maintain service levels across this huge portfolio. So, okay, to sort of summarize the key things for you listening, TMR's 2023-24 fiscal year was, I think, really a masterclass in strategic positioning. It was marked by two huge victories, right? First, they drastically improved their financial stability by strategically getting rid of those major bond issues, bringing their debt-to-equity ratio down from that, frankly, alarming level to a much healthier 186%. Huge win.
Yeah, that was impressive.
Second, they successfully drove really high revenue growth and increased how much each visitor spends. That was fueled by consistent long-term capex, yes, but crucially by that digital innovation, the GeoPass platform, and importantly, that strategic shift to the easier, low-friction GoX cashback system.
Yeah, what really stands out to me is that stunning trade-off they made this year. They achieved massive financial flexibility, got rid of huge debt burdens, and they clearly built the engine with dynamic pricing, GeoX, new infrastructure to maximize revenue from every single visitor. Yet, they still posted that consolidated net loss. Mainly, as they said, because of soaring labor and energy costs they couldn't fully pass on.
Your final hurdle.
Exactly. So the provocative thought we want to leave you with is this. TMR has built arguably the most sophisticated revenue-generating engine in Central European mountain tourism. They've secured their financial foundation, looks like, for the next decade or so. The only remaining hurdle seems to be operational efficiency, specifically controlling those costs.
Right.
So the question is, how quickly will that successful dynamic pricing model, combined with the stickiness of the GeoX loyalty ecosystem, be able to finally overcome that persistent pressure from rising personnel costs? When will it push the group from just maximizing asset value and revenue growth to delivering consistent, solid net profit for its shareholders?
That's the central balancing act, isn't it? That's what we'll be watching for in their next annual review, how they manage that final piece.
Absolutely. Well, thank you for joining us for the deep dive. We'll see you next time.